Well, welcome. I'm Judy Olian at Quinnipiac University, and I am thrilled to welcome our guests, David Kaplan, co-founder of Ares, director and partner of the Ares Management Corporation, and co-chairman of Ares Private Equity Group. You can see Ares with the logo. And Vikrant Sawhney, Vic, if you'll allow me to call you that, Chief Administrative Officer and Chief Operating Officer of Blackstone. I'm thrilled to say that Vic has a connection to Quinnipiac. His dad, Shiv Sawhney, was a longtime professor at Quinnipiac. And I'm joined by Osman Kilik, Professor of Finance and Chair of the Finance Department. So thank you, everyone, for being part of this event. And let me remind our attendees to go to the Q&A function on the bottom of your screen and to enter any questions you might have for the guests, and we'll do everything to incorporate your questions. So I'm going to start from the beginning. You each have quite different backgrounds. David, you started as an undergraduate out of the Michigan Business School, the Ross Business School. And Vic, you are a lawyer from Harvard, prior to that at Dartmouth. So tell us how you ended up, both of you, in private equity through these very different starting points in your careers. David, you want to start?
I'm happy to start. So I actually grew up in the Midwest and went to the University of Michigan 30 plus years ago. And it was an interesting journey. And I was very, very fortunate, I would say, in that I was able to get into the private equity industry early, really starting, I graduated college in 1989, moved to New York and worked on Wall Street in investment banking. And then there was kind of a seminal event at that moment in the industry when Drexel Burnham went bankrupt, which caused a lot of businesses to be created from many of the folks that worked at Drexel. And we could certainly spend an hour talking about that. But a big group went over to my firm that I was working at the time, and I moved out west to work with them. And then I met the folks at Apollo who had started their business out of Drexel, alum, if you will. And so it was really fortuitous and fortunate, I should say, that I was in sort of the right place at the right time and was very young and saw an opportunity to be on the buy side. And I'm sure we'll get into it in much more detail as to the attractiveness of why it's interesting to be in the private equity business. But I really wanted to make that transition from being an agent, an advisor, and an investment banker to a principal.
And just so that we finish the genealogy here, from Apollo, a few of you created the seeds of Ares.
Exactly. We essentially spun out of Apollo roughly 20 years ago.
Vic, how did you end up in private equity?
My journey is much less exciting than David's. He was really got to be at the cutting edge of something, and has probably amazing insight and stories. So I grew up in New Haven and spent quite a bit of time in Hamden over the years, actually, and Cheshire and other places. I was a disappointment to my parents because I went to law school, not medical school. And then having done that, I really felt like I was more interested in the commercial aspects of transactions than the legal aspects. Why were we doing something? How was a company valued a certain way? Why was somebody buying company X and not company Y? And I very much wanted to go into private equity because that seemed to be the best way to pull all of these things together. I didn't know a thing about finance. And so I said, geez, I have to learn something about finance, and I'll go and work in investment banking for 2 years. And then I'll go work in private equity. That ended up taking me 8 or 9 years, because life happens and you do different things. And from there, when I was a little bit older, I was kind of in my mid 30s, I was able to move over to private equity.
And Vic, what was it that you said, I wanted to get into private equity from early on? What was it about private equity that was so attractive?
I think it's really interesting when you can look at kind of the operational and transactional and financial aspects of something. And David made a comment which rings true about sort of moving from the agency side to the buy side. And when you're a financial services person, accountant, lawyer, banker, you're a little bit more transactional. Of course, you give advice. It's really important. When you're the owner of a company, it's with you when you wake up the next day, and you have to deal with the good and the bad. And there are people issues, and there are regulatory issues, and market share and competitive issues. And it really gives you quite an interesting lens into all the aspects of finance, but also of business. It's a very full meal. So I found that to be really, sort of engaging and interesting.
And David?
So I have a bit of an entrepreneurial streak in me, and it's really interesting as a banker, an advisor, what have you, you define success on closing a transaction, collecting a fee, and then moving on to the next sales cycle, advice or assignment. We wake up every day with the investments we have in companies, trying to make them better, grow them, be good stewards of those assets and a partner to the management team. And that really, for me personally, fulfills this entrepreneurial streak in me, because we're entrepreneurial across a number of different companies, not to mention ourselves. I'm sure Vic at Blackstone and myself at Ares, we have been building and growing our own businesses. And in a lot of respects, both Blackstone and Ares are disruptive forces in financial services ourselves. And so it's a really interesting intersection of both being an investor, pricing risk, as I like to say, being a good steward of the assets in which we invest, and also participating in a growth company ourselves.
As owners. So let me, before Osman jumps in here, I think it would be valuable for our audience to hear from you both just how private equity factors into the multiple businesses that Ares and Blackstone operates. These are large firms, financial firms, and have several lines of business. So talk about that. And in full transparency, I should disclose that I am on the board of Ares. But please, David, talk about Ares, and then Vic about Blackstone, assets under management and all that story.
Sure. So we manage today about $200 billion. We have roughly 1,500 employees. We have a couple dozen offices around the globe, North America, Europe, and Asia. We are not in Latin America. And the whole ethos of our firm, and I mentioned just briefly earlier that we ourselves view ourselves as a bit of a disruptive force, a growing company. Our whole ethos is predicated on a culture of collaboration across what I like to refer to as related asset classes, of which private equity is one. So we are basically in the private equity, the credit, lending business, and real estate. And by comparing and leveraging off of each other's relationship networks and industry knowledge that is resident within each of those asset classes, we think we're better investors as a result of that. And so private equity is an incredibly important element to what we do day in, day out, but equally important is credit and real estate. And we look to grow those asset classes because it does help retention and career growth inside of Ares to keep your best people if we ourselves are growing. And so that's a very, very key piece to being a very good company ourselves, delivering good performance in our assets that we manage.
And I should add that you have about 1,400 employees or so.
Roughly 14, 15.
Yeah. And of those, how many professionals? Just to give students a sense of.
Yeah, it's the historical ratio would be kind of 1-to-1, investment professionals to back office, if you will. For us, it's more like 1-to-2. back office. We're at 525 investment professionals. I think the operational intensity of what it is we do, Blackstone does, other firms that look like ours that are at scale has only increased. And therefore, that ratio has deviated from a historical 1-to-1.
Vic, talk about Blackstone.
Sure, and I'll talk a little bit less about Blackstone, and a little bit I want to follow up on a thread that David was pulling on at the end of his comments. But Blackstone, we have about a little more than $600 billion of assets under management. We have about 3,000 employees, and our footprint, I think, is pretty similar to Ares in terms of geography. And we operate in a lot of different businesses. We kind of identify them as real estate, private equity, credit, and hedge funds and hedge fund solutions. But within each of those, in our private equity business, we have a secondaries business. We have an opportunistic business. We have a life sciences business. We have an infrastructure business. So there are sort of layers and layers of businesses. And I think David made the exact right comment is, the sum of the parts has to be greater than the individual parts in terms of connectivity, intellectual property, thought, all of that. That's I think a really, really important and compelling point. The thing that I wanted to raise, which I think is where David was going, is as you think about careers as a younger person, these firms, these large alternative asset managers, they're all sorts of jobs that are meaningful, remunerative, exciting jobs that are not just the job of being a private equity deal professional, which is the one that people think, that's top of mind. But whether it's in other asset classes or, in our firm, I'm sure the same at Ares, whether it's in fundraising or tax or accounting or technology, which is an area where we're hiring a lot, there are lots of jobs that people don't think about when they're coming out of school. And the industry, I think, frankly, hasn't fully professionalized how it hires because the industry has grown so rapidly. And so if it's an industry that you're interested in, don't just think about the one job. Think about all the different jobs, and you'll find more opportunities. And I like to tell people that, to be an analyst or an associate in a top private equity group, that's really hard. Thousands of people apply for these jobs, and there are not that many of them. But there are all these other interesting jobs that you may find as rewarding or more rewarding. And so be kind of open-minded as you look into this as a potential area of employment.
Thank you. And so I'm gonna turn it over to Osman, but let me remind everyone to put some questions in. And I think there are a lot of questions already. And maybe Osman can take off from George's question about what is private equity. Go ahead.
Oh, okay. Right. I have to read the question first, right?
I think it fits with.
I think it's in general. The idea is here because we have so many of students of us, and then when it comes to investing, the only thing they understand investing in the stock market. So, what is the difference between investing in the private equity versus the public? The stock market. David, it's kind of, if you can explain, that would be very nice.
Absolutely. So it's really interesting when you take a really big step back. There is this very large and expanding set of asset classes, generally in the private markets, meaning that when you want to make an investment or you're looking to make an investment, it's not as if there's an exchange or there's some form of intermediary or trading desk that is making a market in that security, whether it be equity, debt, real estate, etc. And what's happened around the world, and I'm sure we might get into here some interest rate discussion, is there is a global hunt for yield by investors because returns are reasonably muted, in particular in credit. And so what a lot of investors have started to do over the last decade to two, and it's really led to a maturation in private equity and private markets generally, is rotate capital into these less traded or untraded markets. And so very simply put, if you buy a share of Apple, that's a public equity. If you buy a technology company that's an enterprise software company in a private equity fund, and you own 100% of it, you as an individual, another institution who would like to make an investment in that company is simply not able to. And the way to access that ownership of that company is through the private markets or private equity, which is what we do day in, day out, not just in equities, but also in credit, real estate, et cetera.
Big, somehow related question is the process that you pick up a company and then ultimately take it to the public. How does it work?
I think, well, every company is different. You know, sometimes you might sell it to a big strategic conglomerate. Sometimes you'll take it public. Sometimes you might sell it to another private equity firm. Sometimes you might own it for a long time because you really like it. But I think what's critical is upfront addressing, you know, what's the value creation opportunity? Like, what are we going to do to make this company better? Is it we're going to expand it geographically? Are there a bunch of product lines that they could be in that they're not in? Are we going to do acquisitions of smaller competitors? So identifying that value, the world is too competitive. You have to identify that value creation strategy up front, and then have the resources, the experts, the people to execute on that strategy. And what will happen is if you make the company higher growth, more profitable, bigger, then you'll have lots of opportunities to, you know, ultimately monetize your investment and make a successful deal. But so I think it's about upfront identifying what are the good neighborhoods, thematically, top down, what are the sectors that you believe will have strong secular tailwinds, and then within those good neighborhoods, what are the places where you can create the most value?
If I can pick up on Osman's questions about what is private equity, there's a question here from Ryan that says, could you break down the difference between private equity and venture capital? Vikrant, do you want to?
Yeah, I think it's stage of company and oftentimes control. Venture capital, maybe companies that are in some cases pre-revenue, but in most cases, these are not companies that have positive earnings or positive cash flows. And oftentimes, not always, but oftentimes you're a minority investor rather than a control investor. So I think the risk return calculus is very different. In a venture capital portfolio, you might have, I'm making these numbers up, 5 investments out of 50, which generate all of your return. And you might have 45 investments where you lose all of your money because earlier stage, more speculative. And you know what one would call the distribution of returns will be much wider. In private equity, you're buying, not always, but in general, mature companies that are profitable and cash generative. And again, not always, but often you're controlling the company. So you're controlling how capital is allocated, who the C-suite management of the company is, and ultimately how your exit is. So it's really, I guess it's really stage of company. Venture capital much earlier, private equity much later. There's something called growth equity, which is sort of in between those two.
And David, another question from the audience here, picking up on your discussion earlier about the low interest rate environment and how investors are looking to have more outsized returns. So Cameron is asking, and I mean, this is close to our own sweet spot here at the university. Could you please talk to the involvement of private equity in university endowment investments? Why are university endowments investing in private equity?
Wow, great question. And it is interesting. If you were to bucket institutional investors into various categories, sovereign wealth funds, pension funds, whether they be public or private pension funds, university endowments, I would say that many university endowments, and this is a sweeping generalization, have been more forward-leaning into private market investing, alternative type of investments, the kinds of things that the Ares and Blackstones of the world do. And the reason is because obviously there's a cost of education and inflation around that that has existed. That these endowments that are supporting the mission of universities and colleges, need to get return to achieve. And so, that's really, I think, at its core, why you see endowments, but it's not just endowments. There has been this increasing percentage across all institutional investor types allocating towards more of these private market investments over the last 10 to 20 years, as we've seen this muted, yield environment that we've all been living in.
And also because endowments have a longer time frame of returns. They talk about in perpetuity.
So duration is a very important concept in what we do. Liquid markets, the stock market, you are literally on a minute by minute basis during a trading day making a buy, hold, or sell decision, and are able to do that. Vic, I'd actually double click on something he said quickly, which is secular themes. You must, when you buy a company and you control it, and by the way, in venture capital, this is also incredibly important to being a successful venture capitalist. But in private equity, you really need to get the secular right, because you're going to live with these companies that you invest in and control for many years. And so it's not as if you can quickly pivot to the extent you got your analysis incorrect. And so there is a great match with endowments in terms of the duration, and the private equity is generally a 10-ish year to 12-ish year fund life that's committed and locked capital. So that does fit well to your point, Judy.
So I'll ask one more question and then go back. This is a clarifying question. In a sense, how do you make money, Vic, from private equity? What's the structure of making money?
Yeah, I think it's actually a great structure because the incentive alignment is so high. So there are two ways that you make money. One is that you charge the investors what's called a management fee. So that's some amount of money that you're paid annually. It's typically 1.5%, could be more, could be less, depending on the particular program. And then you receive, the firm, Ares, Blackstone, whomever, receives what's called carried interest. And that's effectively a profit share. It's typically in traditional private equity, it's 20% of the profits of the investment. Oftentimes, not always, but oftentimes you have to achieve some minimum return to the investor. That's referred to as a preferred return or a hurdle. And the investor typically has to make 7 or 8% before the Blackstone or Ares or whomever receives any carried interest. And typically in traditional private equity, you only receive that carried interest when you sell things. It's not based on where you have them marked. So you receive a profits interest when your customer receives cash money, not because you think something is worth more or less. And so the alignment, the investors always look at net return, net of fees, net of carry. What am I earning? And what you've seen over long periods of time, and you can't ever look at a short cycle of 2 or 3 years, good or bad, that net of fees and carried interest, the endowment, the pension plan, the sovereign wealth fund is earning hundreds of basis points of excess return relative to the public market. So I think the alignment of the model is really strong and works really well for the investors.
So Gabriel asked, what type of return do you expect to receive from your portfolio companies? What is it that you would tell an investor to expect?
I think, and David should chime in as well, a lot depends on what the risk-free rate is. And, in an environment where the risk-free rate has been 0 for a long time, you can only earn, there's only so much premium relative to the risk-free rate that one can earn. And so in this sort of environment, I think with truth serum, if someone is delivering a 15% plus net rate of return to an investor with predictability, low incidence of capital impairment, low volatility, I think that's pretty good, actually. But David should weigh in as well.
I would say it's great. And that's certainly what the market has been conditioned to accept. And I don't know how granular we want to get in this discussion about what's worked over the last decade and what might work over the next decade, which could probably look different, which will probably look different than what was the last decade. But we've all benefited, even if you're a public market investor, private market investor, with increasing multiples. And whether it's a PE multiple, an enterprise value to cash flow multiple, and in venture revenue multiples, they have gone up. And there's been a very significant reflation, if you will, or inflation to asset prices and risk assets. And so that has benefited returns historically. And so I would go back to something Vic said, which I think is really important, and certainly those that are listening that are thinking about their future career growth, it is so important to make businesses better no matter what part of the private equity landscape you're playing in, because at its core, if you're doing that, you're able to generate the kinds of returns that Vic just mentioned, I think on a consistent basis, even with a lack of future increase in purchase multiples and valuation multiples, which I would project are going to be much more muted going forward than we've certainly experienced over the last decade.
Judy, if I may, David, it's related question. There are a couple of them. It's just you already open up and Vic start talking about the low interest rate environment, exceptional low on a historical framework. And then its effect on the valuation, the multiples just basically went up tremendously, both in the public market and private equity side of it. But right now, as you have indicated, last 10 years doesn't indicate anything about the next 10. And the question becomes, inflation has started going up. Expectation, 5-year, the break-even rate is about 2.5%. And we'll be surprised if you end up seeing 3-4% inflation level sometimes this year. And then the rates, especially 10-year notes, and then the rest of them on the long end side of the, the treasury curves has been going up. How do you think that it will affect the deal activities 2021 and beyond? And what may cause, the kind of effect on the multiples that you mentioned?
So, as in all aspects of life, sometimes people go a little pendulum swinging too far in one direction or another, and you could have too much of a good thing. And I think there's been a lot of capital rotated into private markets. And the question is, where are we on the supply-demand intersection of capital and available opportunities? And so almost a bit divorced from the interest rate discussion, I think, in my opinion and my judgment, the availability of capital in private equity and elsewhere in private markets and in fixed income markets, which are used to finance much of private equity's activities, is going to drive continued robust valuations. And you just see this, you turn on, CNBC or Bloomberg TV or Fox Business or whatever channel it is you watch, and you see this literally day in, day out. We are living through, I think, in the next 12 to 24 months, absent something truly exogenous and unexpected, which is what the definition of a shock is. Certainly the pandemic was a shock. There's been so much liquidity put into the system, fiscally, monetarily, and otherwise. I think multiples and deal activity remain reasonably high. I just don't see another cyclical correction. Now, I will say we are creating potentially bubbles in certain places today, because if you do accept my thesis or my hypothesis that there is too much liquidity in the market right now, that tends to result from too much liquidity, and those bubbles ultimately could get popped. So it's a really interesting environment to be, quote, pricing risk today in all asset classes, and private equity is not immune to that.
Osman, you want to ask another question?
Oh yeah, it's just related, just David, and I'm gonna go to the week. David mentioned all of them, and is the expectation because of the tremendous amount of liquidity that valuation will stay high. And I'm gonna relate to somehow to the value of the dollar. Because if the liquidity is gonna stay high, dollar seems to be holding very well. And what do you think that the effects on this high liquidity environment in the dollar with the higher potential inflation rate, and how they may affect the deal activities, international especially? Vic, you wanna?
Sure. Yeah, that's a tough question. Which I'm not a currency expert, but I'll just give you my sort of layperson's common sense view, which is, I think there's a whole question around inflation and whether it will be temporal or long-lived, and there are very strong arguments by very smart people on both sides of that argument. On the one side is the unprecedented, double-barreled stimulus of monetary and fiscal stimulus in an economy that is going to recover on its own very, very sort of aggressively or well. On the flip side, we have an aging population and ongoing technological improvements, which will be, sort of a dampener on inflation. So good arguments on both sides. There's this belief that structural long-term inflation is a thing of the past. I don't know if that's true or not. I'm reading and thinking a lot about it. I think, what does that mean for the dollar and for private equity? You have to look at these portfolios are so global that you can't say, well, geez, a stronger dollar means X and a weaker dollar means Y, because your companies have import costs, raw materials costs, customers, all over the world, and you're investing in businesses, whose domiciles and whose cash flows are in different places. So, and whatever will happen over the course, the dollar might weaken, it might strengthen again. I think maybe this is too much of mom and apple pie, but if you buy high quality businesses in good sectors and you're taking a 5 to 7 year view, now you can get lucky or unlucky on the currency, but it will not be the driving force of a multi-year illiquid investment. Of a short duration, whether a credit bet or a currency bet, it can be all of the driver of return. But when you're taking a multi-year view, it will not be the main driver of return. So I kind of punted your question, but that's how I think about it. Over to David if he wants to take a stab at it.
So I would, I'm not going to get into predicting stagflation, which is absolutely a scenario that I could paint as a probability of an outgrowth from here and a lot of the activities happening. But to me, the way I think about it, I describe this a lot and talk to our investors a lot about this, is there's sort of a battle of the titans taking place right now in investing, of the cyclical battling the secular. And my personal view is, when we are sitting here 5 years from now, if we do a way forward 5 years from now, we look back at this conversation, we will have declared that the secular will have trumped the cyclical, meaning those forces are so powerful. And it's really what Vic just said. It's this acceleration of transformational change across every industry on the planet, and the way we all interact together, not only just as a commerce comment, but socially and politically and otherwise, because of technology, that you have to get the secular right if you're investing for the long term. And so, yes, we could sit here and debate the dollar, the weak, strong, inflation, et cetera. All those fall into, for me, the cyclical bucket. Much more important is to analyze and get that secular piece right, and really be thematic in your approach to investing if you're doing it in a longer duration format like we do in the private markets.
So I'm going to ask, because we have a lot of themes that we want to cover and we have much less time, that we try and get through more questions to cover a lot of the themes that are coming up here in the questions. I want to go back to a fairly basic one, and I'm actually going to riff off something that Dominic asked here, and that is, how do you evaluate the deals that come your way. What's the deal ratio of what you look at versus what you invest in? And what are some of the key criteria that you evaluate? And I know that's a humongous question because you go through a laborious, detailed, rigorous process. But talk about the process a little bit. Maybe David, you start.
Well, I don't want to tell Vic any secrets here, so I got to be really careful because we are friendly competitors. But you know, in all seriousness, really just going off of some of the commentary I just made around the secular, we start by, you know, really organizing ourselves around industries, but looking at what we refer to as relative value that is available in different industries, and try to identify some themes that we're excited about that we think we can get behind in those respective industries, and then try to identify companies on a proactive basis using our network of relationships. And we have all kinds of techniques that we undertake and utilize, and the platform gives us at Ares Management itself a very big advantage there. And we try to identify companies that we think will transact or sell themselves or look for capital to grow faster, and get ahead of processes, if you will, that when a company actually puts itself up for sale. And that's really at the top of the funnel. You ask about ratio. As a math person and as a, you know, our organization is built around people, process, and culture. Our process has a bit of math associated with it. If you just try to probability weight making a few good investments a year in a given fund strategy, looking at as wide a funnel at the top so that you can assess multiple opportunities and look at the relative value of them to make those few investments, that's ability to be selective leads to better outcomes.
So Vic, drawing on David's response that it's clearly a proactive, deliberate process as opposed to a reactive, opportunistic process. What is it that drives what buckets you're going to go and invest in? Is it people? Is it opportunity that you see? Is it an ecosystem that you want to create around a hot area?
It's, and David said this and he's right, you know, the macro overwhelms the micro. And so, you know, for us, thematically identifying where are the neighborhoods where we want to spend time, you know, that's I think arguably the most important decision. And so for us, you know, if we, you know, made a decision many years ago to allocate capital in and around digital disruption, that was not a unique thought. Lots of people had that thought, and that expressed itself in becoming a very large investor in warehouses and logistics, which is not a particularly sexy, exciting thing to own a bunch of warehouses, but it's a pretty good thing to do. That same thesis would get expressed in enterprise software, which is a very common theme, but also in things like mobile payments, online gaming, online dating. So you build these thematics and then you invest around them, because those are the places where you think there's going to be the most growth and the strongest kind of secular tailwinds. And sometimes what you have to look for is what are the second or third derivatives of a trend, because the first derivative may not be investable. It's too expensive. You know, it's transparent to everybody. So there's not good value. So what are the indirect ways to play what you think are the most compelling trends?
Give an example. I think one of the examples is warehouses for lab space in the pharma field.
Yeah, so that, again, I don't want to cross any you know, public-private lines, but for us, the growth and investment in the life sciences area globally is profound, and this is a mega trend. And what's happening in drug discovery, precision medicine is really significant for all of us as humans. And one of the ways that we've invested in that space is being a very large owner of life science office space. And so again, it's somewhat pedestrian in a way, but it's, you know, these are office spaces that need to be in certain cities where the talent is, and you cannot conduct R&D via Zoom. You must be in a properly equipped setting. And so that's an area where we've been very active. And, just along the life sciences value chain, there are companies that provide consulting services to life sciences companies. There are logistics businesses that provide storage and transport. There are all these sort of derivative, sort of less sexy or high profile ways to play these compelling trends.
And David, just so that we calibrate people's expectations here, about the very low hit rate once you evaluate companies and actually invest in them. What is that ratio typically?
So it depends, it really is a difficult statistic to quote. But I would say we're probably, and again, you're planting a lot of seeds in any given year that could grow into a transaction or an investment a year or 2 or 3 later. So that is something very important to keep in mind. But, it's not atypical for it to be 1 out of 100. We look at 100 things in a year and we winnow it down to 1. And the fact that there's concentration in a typical private equity fund, I would say this is very, very generic statement, 5 to 10% positions. So you're talking about 10 to 20 companies in a given fund. That's why selectivity of assets, backing the right management team, backing the right business model, profit model, going after an opportunity is so important. And that's why looking at so many things to find the right fit for what it is you were looking to express in terms of a secular view is critical to the whole model. And I think we have in the marketplace, we being Ares and Blackstone, a bit of an unfair advantage. If you think about what Vic just said, he was actually talking about multiple asset classes in the private markets, real estate, private equity, and possibly even credit, touching this thematic approach to life sciences and the disruption and transformational change happening in that industry and the growth. And so he has multiple colleagues and partners pricing risk in different asset classes, comparing notes, relationship networks, et cetera. So I do think as people assess their careers and where they want to work, it is important to look at the embedded edges and angles that a particular company has in any industry, and private equity by no means is an exception to that. You really need to have a differentiated model, in my view, for today's day and age of putting money to work.
Osman?
Yeah, it's just sector related question, David. I know the pandemic is suddenly changes here now. The way that we look at the world, everything, education, all those businesses, working from homes, all those type of things. The question becomes, how do you see the investment opportunities in the commercial real estate market?
You want me to take that?
That's your David, yeah.
Yeah, so it's really interesting. I would say that when you look at the pandemic and you see certain things that were pre-pandemic trends that are accelerated as a result of the pandemic, new learned behaviors, both commercial business behaviors and personal behaviors. And then there are some trends that absolutely got catalyzed, I would say, in large part in the pandemic. And one of the questions you have to ask yourself is, what is the long-term implications of some of these accelerated and catalyzed trends from the pandemic? And how does it then affect utilization of real estate as one specific example, whether it's office, whether it's hotel, whether it's distribution and logistics? Because certain sectors benefited, get what we refer to colloquially as a COVID bump. Distribution and logistics would be an obvious place as people are buying more things, utilizing supply chains more direct to consumer and consuming things more in their home. And then conversely, how do you think about office space in an environment where you may have more hoteling style models where people might spend 2 to 3 days a week working from home or virtually and you therefore require less square footage. Me personally, I believe that there's no replacement for in-person team building and team deployment. And I think we are going to see some return to what was pre-pandemic. We will never be the same on the work from home environment, but it won't be as radical as maybe some are projecting, in my opinion. So these are the kinds of probability weighting exercises investing in anything that's been impacted by the pandemic, and certainly commercial real estate would fall into that category.
It's just related question is just if the paradigm is shifting, doesn't matter whatever it is, what direction, some type of new models, how do you think that it may affect the workforce, especially potential, the new college grad, internship, potential jobs, and so on, especially in the private equity space?
I think I agree with everything David said. I think there's been a little bit of recency bias and overcorrection on how dramatic, the change in workforce dynamics is going to be. It will be an evolution. It's always an evolution. It will not be a revolution, my personal opinion. So I think for new grads, one, technology is a huge enabler of engaging with more firms, more people, right? The outreach, you can really scale your outreach, and not uniformly, not necessarily in private equity, but generally, I think there will be more job opportunities where you might live in Hamden, but you're gonna work wherever in Los Angeles and you travel. So I think it'll create more flexibility. The flip side is it will create more competition, right? You were already competing in a global marketplace for talent, and this the learnings of COVID and the leveraging of technology are going to, I think, will make the talent marketplace even more global.
I'm going to pick up on what Osman was saying about careers, but I want to ask a question that has come up 2 or 3 times about in our questions about SPACs, special purpose acquisition companies, which seem to be the latest new rage in market financial structures. And the question is, are they complements or sources of competition to private equity? And I don't know if Vic, you want to start on that?
Sure. Yeah. I think they're both, because not all companies, some companies desire to be public. Private equity, they don't want to be private. So for those companies whose objective is to be public, this is a complement. The second point I would make is SPACs have become an exit vehicle for private equity, where private equity backed companies, maybe the story is a little bit more complicated, maybe it takes a little bit more time. This is another exit market in addition to all of the other exit markets. But to some degree, when there's more capital competing for deals, you can't say it isn't a source of competition partially. But I think it's all three. It's a complement, it's an exit mechanism, and to some degree it's competition. I think the SPAC market, you didn't ask this, but I'll say the SPAC market, there is a pro-cyclical element to it that will get reduced, and the alignment structure over time will have to change, I think. But the SPAC phenomena, which is those of us who are older, has been around really since 06 or 07. This will stay around, but the structure of these vehicles, the selectivity of who is able to raise one of what scale will evolve as this becomes a mature, more efficient asset class. It's a little bit of the Wild West today, and that will change and evolve and mature.
David, do you have anything to add?
I agree completely. I think maybe the word reckoning is too hyperbolic, but there's a shakeout coming. There's just been too much capital rotated into it. But the biggest takeaway is the SPAC method by which a company can go public has, during the pandemic, been normalized. It was kind of this this will also sound maybe more of a back kind of water type of way to go public. Historically, we actually rescued a broken SPAC in 2008. So we've touched that market for a long time. We have a SPAC of our own. I know Blackstone has played as well in the space. So, but I do think an institutionalization of SPAC managers is going to come on the other side of some sort of equilibrium point that we'll see here in the market when we go through a cycle.
So let's just go back to something that Osman started on, and you both mentioned other career opportunities within private equity. You talked about back office. So talk a little bit, both of you, about how a recent college graduate might try to enter the public equity domain and not necessarily in the frontline investment capability. So Vic, do you want to start? And then David.
Sure. I think, and I don't know how helpful the comments will be, but I think all of the major firms have pretty good job postings and, access to what's available. And LinkedIn, which I'll confess I just learned how to use this year. LinkedIn is a very, very powerful tool to build bridges and connectivity. And what happens is, unfortunately, the demand for these jobs far exceeds the supply of jobs. And so you need to have something that differentiates you, something about your experience that shows that you really have an interest, a passion, a skill to engage with one of these firms. Sending your resume out to 100 places via email without some hook, may not lead to many responses. And so I think working networks, participating in conferences, particularly in Zoom, following up with people that you can meet through whatever networks are available to you, academic, personal, professional, you have to kind of work all the angles to get your foot in the door. And you have to have a reason. One thing that I'm always a little bit surprised by is when we interview people, there's so much good information available in the world that when people don't come in having read a lot about the organization and their answers are pretty generic, I'm always a little bit disappointed by that, because you can talk about, by spending 4 or 5 hours reading, why Ares is so special. And they did these 3 deals, which are very aligned with your own thinking. So try to customize your approach rather than a very generic, I'm interested in working at your firm because it's great. I'm not giving a great answer, but it really has to be like surgical, tactical, not just like a blanket the waters approach. That is a very hard approach.
David, anything to add?
So as a parent of 3 kids, one's 25, one's 23, I talk a lot about hustle. You really have to hustle. And in the private equity business, networking, to really talk about what Vic said is very, very important. And I would emphasize trying to put together and think about, if this sounds desirous, touching the private equity world as an investment professional, as a portfolio management person, as a tech-oriented person, looking at the LinkedIn job descriptions, just as Vic said, and said, oh, wow, there might be some interesting fits for me. Put a plan together, a 3, 4, 5-year plan. I'm going to work at an accounting firm, and I'm going to try to steer my work towards, covering sponsors in private equity, because that will then lead to this 3, 4 years down the road. And so I think thinking forward, the way forward is very, very important to managing getting into private equity. It's unusual to graduate and boom, be in private equity. That is tough to do, but you can go down the lane of accounting, the lane of consulting, the lane of investment banking, et cetera, and think that through.
May I ask something it's related, David, is just because both of you mentioned that based on your work was about health is back office, other health is front office. What is the way to move from the back office to the front office? What is the process?
So I think I may have said back. I don't like the sound of that.
Yeah.
So try not to say that. I may have said it. So but there's investment professionals and then non-investment professionals. Once you get into a firm like ours and you prove yourself and you are, I think one of the advice I give anybody in any career, in any professional, is manage your career. Find a mentor, express a desire. So if you're in the finance and accounting department of one of Blackstone or Ares, and you want to get into the investing business, find a mentor and work with them to figure out what that path might look like, and milestones to get there. And if you want to be in portfolio management, which is more of an operational assistance function for companies in which we have investments in and control over, very, very important and very valuable, and even more so over the next 10 years than it has been over the last 10. If that's something you want to get involved with, you can, again, work to manage your own career. Very important.
And we probably have time for one last question. I'm looking at that, and thank you for this glorious sweep of the industry and markets. But if you could each give us a clear-eyed view, a very authentic response to what are the highs and what are the lows of being in the private equity business for someone contemplating an aspirational career. Vic, you want to start?
Sure. I think it's pretty similar to any job, really, right? The highs in private equity tangibly are when you make a deal that you think is interesting and that you're passionate about and you're able to do it. But what's more, the greater high is when through your and your team's effort, you create a better company and you're able to realize that value and validate all the work you did. So that's the ultimate sort of, I think, feeling of success. When you've created a good company, you've made it better through your efforts, and then you're able to monetize those efforts. The lows are like any other job. You work on many deals that never happen. You will work on things where you make mistakes and you screw things up and you have bad deals. It happens to everybody. But I don't think that's different, from any other job really that you do. You're going to have success and failure, and you learn a lot more from your failures. You tend not to learn a lot from your successes. You learn a lot from your failures. And so I always view that as a sort of a long-term positive, even if it's a short-term low.
David?
So, very similar comments to what Vic said, but certainly the highs are growing businesses, adding jobs into the economy through those investments, walking into a public pension fund client, showing them your results, knowing that you delivered for them and for their constituents, and meaning their pensioners. That feels just really good. And we are, we very much think of ourselves as a purpose-driven and mission-driven organization to deliver returns for our investors. And as Vic said, when you're in the risk business, you make mistakes. If you're not making mistakes, you're not taking enough risk, and therefore you're not generating the kind of returns that our investors look for. So those are always tough. You definitely agree with him. I agree with him 100%. You learn more from the mistakes, but how you manage those mistakes will define you maybe more than your successes. By the way.
Osman, do you want to have the last word?
Oh, these are great questions and answers. I really appreciate it. And from our student perspective, one of the things that we face, they always, as a young person, look for that dream job. But that dream job still probably is another 10, 20 years away. You need to start someplace. So that adjusting your expectation is a challenge that I see. What do you think, David?
So we're living in an age of instant gratification, and technology has facilitated that. And when you're dealing with a career, you really do have to manage your expectations and put those building blocks together to get to your ultimate goal. And that's why I made that comment of put a 3, 4, 5. It's hard to look beyond 5 years, frankly, but put a 3, 4, 5 year plan together. And I think when you're on the other side of that in year 4 or 5, you'll be glad you did.
Vic, anything to add?
No, I think those were wise words. So I will not. I I think those were perfectly well said.
Well, I want to thank you both, David and Vic. Thank you for educating us, not just about private equity, but also about just reasoned approaches to markets and to careers. Thank you so much. Hope to have you back. Osman, thank you for being my partner. And we'll see you on the next way forward. Thank you.
Thank you very
Vic.
much,
Thank
everybody.
you, David.
Take care.
Bye-bye
Thank
now.
you. Bye-bye.
Bye.